Yes, hello traders. I hope you're well today. Thank you very much for attending. Thank you, FX Street, for kindly hosting this event. And it's always a pleasure to try to share my experience and my knowledge with the developing trading public as well as the experienced traders. Just a little bit about my background. I've been in foreign exchange now for 14 years and been managing FX for the better part of 10, 11 years. I really have a lot of experience, a lot of institutional experience. And so some of what I'm going to share with you today comes from a pretty depth understanding that I have of the function and the mechanism behind driving price volatility and order flow from the functional standpoint as it happens electronically and how it's reflected on our charts. Okay, so it's really, really important to understand that while I appreciate and understand that you will probably attend, when you go through the early stages of developing as a trader, you attend a lot of webinars and you're really just really kind of going out and gathering information and accessing resources to try to determine and refine ultimately who you are as a trader, what you gravitate towards, what type of trading profile you want to establish for yourself, and ultimately refining your process of development and execution as a trader to really become an independent thinker. And so I realize that every single trader that presents in webinars has a different approach. And so I've designed this webinar in such a way that, we're just going to be going to live charts. But I think the information that we want to cover here is an approach that I use for taking entries. And I'm hoping that there's something in there that you can either adapt to how you currently trade, or if you're still trying to find a way to trade. My trading is a price action based approach. So, you may connect with it, you may not, because a lot of you use mathematical models and indicators and whatnot, which I don't use at all. So hopefully this can give you sort of just a different perspective on things as it relates to your personal trading. Okay, so what we'll do is, if you have any questions, we can just let me get a little bit into the webinar and get just some information out first, and then I can start entertaining some questions as we see fit. So I'm just going to pop on some charts here and give you an idea as to how I trade. So today we're going to talk a little bit about entries, the price behavior that I look for when taking on entries, specifically for intraday trades. Now, I basically do the same type of protocol when I am taking on position trades as well, but we'll get into that discussion a little bit later on. So it's more, I'm assuming that the majority of you are mainly interested in trading intraday volatility. So we're going to cover some of the price behaviors as it relates to that and the entry. So first thing I need to do is just give a little bit of background as to sort of my general, very, very general trading profile. I'm a price action trader, both for intraday, for medium term and longer term. However, for the longer term trades, I do obviously will incorporate strong consideration to the fundamental overview and where we are in terms of overall market sentiment. Now, this is really what one of my charts would look like. I really don't have any indicators. There's one down here now, but if I did have an indicator on my chart, it would be extremely secondary. I rely solely on repeated price behaviors that we've identified in the market. And while this chart just may look like a bunch of candlesticks to you, to me, I see I could literally talk about one chart for hours. So let me just go over some basic price features first, and because we need to have sort of a general idea of some of what we're looking for when we're looking for the levels at which we make trades. And from there, we can move in more specifically into exactly where I'm looking to take an entry and what type of price behavior that I'm looking for to take an entry as well. So this is an Australian US dollar 60-minute chart. And so we're just going to use this chart to show some examples. And while I'm going to give you just a very, very brief discussion on sort of the function, I wanted to show you what type of price behavior I'm looking for. So you'll see in this chart, you will see that there is a price move here, for example. So obviously it's a 60-minute candle here and here, and then you see price very, very quickly draw back within a few hours. Quickly is all relative. So whether you're looking at a 1 minute, 5 minute, or 1 hour chart, it's all relative. So price spikes out and draws back into this leg. And let's just talk about this one specific price feature. Some of you may have seen some of my webinars on price inefficiencies and volatility, and we're just going to give a quick overview on that. So as price moves out, first of all, you'll see here price consolidates, and part of the consolidation can be whether it's time of day, the market's waiting on data, or what have you, but price consolidates. Now, when price consolidates, there is a function going on in the periphery of the market that is effectively unseen. So as price is consolidating, what it's telling you is the market is being drawn into these price reference points, the range at which price is currently trading. And in this particular case, we're waiting for volatility to pick up based on time of day and some data. And but as price consolidates, liquidity is effectively drawing away from the near side of the market. Okay, so price consolidates, liquidity is drawing away. So therefore, during a non-volatile time in the market, as liquidity draws away, we actually have a somewhat exposed area on either side of the market. Now, you can see that as the order flows start coming in, price will move out. And when it moves out inefficiently or spikes out inefficiently, it immediately or very, very quickly can draw right back in. So this is a 60-minute chart, but it could very well be a 15-minute chart or a 5-minute chart and effectively look exactly the same. So what we're looking at here is as whatever it is that drives price out, we see a fairly inefficient move. Now, there's a mechanism that I'm going to talk about in a moment that pushes price and creates a compounding effect running price, and it leaves a void in the market. So price will often draw right back into that area of inefficiency or illiquidity in order to build up a volume base. Now, when I refer to volume base, I'm referring to transactions. Now, so we see this price behavior, and although this is a 60-minute chart, we're going to look at it on smaller time frames in a few moments. But as price runs out, we've got inefficiency here, so there's less psychological connection, but also it's a function of the pricing engines. So price runs out, comes back in to typically the breaking point, and responds. And this pattern is repeated virtually over and over and over again. And we see it here. Price runs down, draws back up. Price runs down, draws back up. And in this particular case, for example, so as price moves lower and draws back up, there are specific areas where we're looking to make a trade. We call it the anatomy of a price swing. Now, as price draws back up, one of the places that we're looking to make a trade is that we have a highly inefficient breakout move. We're looking for the breakout point, so an area of response at the breakout point, and an area of response at the point of origin. Now, we're not going to get into all those details today. We're going to get into exactly what we're looking for on entry, but we need to give you some background first. So as you can see here, the Aussie dollar is rallying right now, and we anticipate that the Aussie dollar will stall around 88.15 to 88.20 area and should draw back. And why not the exact highs? We actually see there's this point of origin where price runs down is typically quite sensitive. So so we're basically looking for these inefficiencies to move. So now what I need to do is I just want to take over and just do a quick lesson on the pricing engine, because that's effectively what we are this is what we're trading. So first of all, I want you to understand that volatility is a function of liquidity. So when we're watching price, this is a payrolls example. So when payrolls comes out, remember that liquidity on either side of the market is extremely thin, particularly in payrolls. It's one of the thinnest times in the market. So as the data hits, price is so thin, all we need is a small pop on one side of the market, and the market has to go find a counterparty to the order. So volatility is quite high. And so volatility is a function of liquidity. So on either side of the market, any liquidity that comes in the market has got to find the counterparty. So then price settles down, we have a volatility picks up, and then price starts to move. So you can see the difference in the liquidity pre-release versus post-release. Very, very distinct difference in the price action here in this 5-minute chart. So understanding that price is a function of volatility is the function of liquidity, let's just look at how the pricing engine works. And this is exactly what we're looking for when we're taking entries. Now, and we'll take it to real-time charts as soon as we get to it. It's important to understand the foundation. So as in this case, as you get near an event, or whether it's a known event, a data release, or a central bank speak or otherwise, whether it's a known event or a non-known event, the same function applies. So as you near the price move, liquidity on either side of the market is typically drying up, and I think we're seeing it on the pound right now. But so as price starts to move out, what I've done in this example is I've just basically laid out a fairly simple example in that when price consolidates, liquidity is dropping off, and that's why price is consolidating, is that liquidity is stable, the market is waiting on something. All we need is a couple blocks of orders to come in and just start to push price. So if we have on the sell side, let's just say we have constant flow. So as we're consolidating here, we have basically an equal balance of flows on either side. And let's just say that on the sell side, the balance remains the same. And we just have a pop come in, say, $50, $100, $200, $500 billion in order flow in a very short period of time. Then what happens is that that gets punched in here, price starts to move, and what the mechanism inside the institutions do, both in third-party liquidity providers as well as the investment banks, is that it starts the pricing engine, and it actually needs to break down the order into multiple segments. So, for example, when we execute trades, we actually have custom in our GUI. If we put in a large trade, we have it broken down into blocks of, for euro dollar, 5 million, and for pound dollar, 3 million, because we need to meet certain price expectancy. So if we just come in with one large block, the banking mechanism needs to break it down, and it will spread the order to the high side. It actually creates a self-chasing pricing mechanism. And so you end up having massive, call them price inefficiencies and gaps in the price move. So price spikes up. So the buy side flows remain pretty solid. Then they thin out. And what we see is that when the buy side flows run their course and thin out, the sell side doesn't need to change at all. You can still have the natural flows on the sell side, but price will start to draw back to its breaking point and point of origin just by the nature of the decline and the exhaustion of the buy flows. Okay, so we are looking for these price spikes not only in the shorter time frame, but we also looking for relative inefficiencies on the higher time frames. So, for example, when price spikes up, we're looking for defined levels, and let's just say they're just support and resistance levels. As price spikes up to an area where there might be a liquidity pool or an area of resistance, just simple visual resistance that you would see on any chart, 30-minute, 60-minute chart, daily chart. So we are selling into that, but we need to see certain price features. So we want to see this leg of inefficiency under a driven price move. Okay, so we just want you to understand this from a functional perspective, and that's, you know, I obviously can't get into a lot of detail because we want to get to our main subject matter. All right, so going back to our live charts, we can see here that, let's just move it down to a 15-minute chart. We can see here that when price moves, there's a few different features. Number one, like in this particular case, for example, we have you see how price moves in this is a 15-minute chart, so it's a pretty inefficient move. We dropped and we stopped. Then we have another highly inefficient move. Then price stabilizes and it's actually waiting on data. Once this breaks, it typically will draw back into this leg. These small areas of order flow will see price response, and we actually make trades in and around these areas. But if you compare an area like this versus a larger area of just resistance, we want to see two price features. Number one, we want to see a very, very clean and open and inefficient break, because notice how the volume dropped off. We have the highly inefficient move on the price break, price stalls, and continues. Now, as price is drawing back up this leg, we're looking for price responsiveness at the point of origin of these moves. And so we actually see it here. We see this little bit of volatility. We make trades in these small areas of volatility. This one doesn't get that far, but that's where we make trades. But we're more interested in these areas here. So we see price comes back up to the point of origin and responds. This was a late day move, late session London close move, which is actually, we prefer the London close move, but price just sticks. Notice where it sticks. You see how we have an area of volume here. Price runs out. It's overridden by this area of volume, comes back, and when it comes back, it stops right here at this area of volume. To us, that's important for managing a trade, and then it just consolidates into the weekend, basically. So now let's just have a look at some of the recent price behaviors on the pound dollar. So the pound dollar today, we had negative manufacturing earlier today. So you'll notice that price obviously drops off prior to the data event. We have the data event, price moves and breaks out. Let's look at this in a smaller time frame. Here's our 5-minute chart. Pre-data, the data comes out, and now when the data comes out, some people might say, well, look, price moved from 64.20 down to 63.20. Why didn't you sell it up here? Well, there's really no frame of reference. Data is a 50-50 shot at this type of data point. However, what we're looking for is look at the price move post data. So you can see, this was early in the sessions here. So we had an inefficient move, and then when data came out, watch what happens. Data is price volatility is a function of liquidity. So price runs up, comes back to the pre-release price, and then starts to run. So this move up right here is quite simply the market basically filling in the spread. Okay, so but you'll notice how it feeds simply back into this Friday move. Okay, so on the Thomson Reuters Icon platform, these numbers are heavily noted. So as price starts to move, here's what we're looking for. Number one, we would look for a sell here, but you couldn't sell it there because of the nature of the price move into that level on this particular day. If price moved higher towards the point of origin for the day, then that could be more of a sell. So again, I'm just want to give you a feel for the price behavior, because some of you may not be familiar with price action, you use a lot of indicators. So I just want to kind of bring you an acquaintance with this, and then we'll get down to the 1 minute chart and specifically what we look for at entries. This is a pound dollar 5 minute chart. So notice how liquidity is very thin, price spikes down, but every time it breaks the low, it draws back up into the break of the low. So price is highly inefficient here. When it breaks down to a new level, you will see price will run. If you ever notice the break of a low, price will jump, and it typically jumps quite considerably versus when price is inside an existing trading area of order flow. Price will jump. So you want to see here, then price makes a new low here. It jumps, comes back up, consolidates, comes down. Notice the change in price when it accelerates through this low. Price jumps lower, comes back up, and then we have a new area of order flow. And I just mentioned this earlier. Watch how price behavior drops off. It gets quiet, so liquidity is being drawn from either side of price. Then as it starts to move, it's got to find liquidity, so it jumps through the lows, seeking liquidity, draws back up into the lows before consolidating. And then it comes back up again, responds to this price behavior. Now it's getting very, very quiet, and we don't see any data coming out, any notable data coming out here in the near future. So we may start to draw back up this leg here. So if it draws back up the leg, we're looking for sells at 63.80. If we move lower, what we will do is we'll wait for a break of the low. If we have a significant, if we have a move just like one of these moves, exactly like one of these moves, through this low around the big figure, we would trade this. Okay, so right now price is extremely quiet, and you can see the change. We have order flow, price rallies, we have a change in order flow. So now we're just sitting waiting to see where it's going to break. We don't chase price, we trade into a price move, which will now bring us into what we're looking for on the entries. Okay, so maybe that gives you, I know it's really hard to give a very short synopsis of this, but it gives you a bit of a feel for what we're doing. So we're trading intraday volatility on price behavior. All right, and again, I realize I've got a blue indicator here. It's just there to kind of make things look pretty. I don't even use it. But this right now gives us a good sense of the order flow. So as price rises up from 49 to 60, we should actually see, assuming there's no major price driver, we've got equities opens in 6 minutes. So we should see a little bit of just change in order flow. We've got an inefficient move from here up in towards 60, more so 80. 60 would be a secondary level, but 80 to me is a lot more interesting. This breaking point from the data right here at 80, to me, we should see a reasonable price response. Here, not a tradable one, but we'll still probably see price stalling in this area, particularly if it's inefficient. So what we look for, so we take it down to a 5 minute chart. Sorry, a 1 minute chart. What we're looking for is this is current price. And let me just try and get the best picture here. So we talked about the inefficient moves and the breaking point of the inefficient moves. So, for example, you see what's happening right at this very moment. It's a good example. We kind of carved out this little area of consolidation on the 5 minute chart. Now we're at a 1 minute chart, and look at how price consolidated. So on a relative basis, the 1 minute chart is very noisy. It's very noisy, and you don't want to. We don't trade off a 1 minute chart. We don't pick our levels off a 1 minute chart. Sorry, a question just came in here about the 1 minute chart's too noisy. And it depends on how you trade, but the levels that we're looking to trade at, we pick the higher time frames, okay, 15 minutes and higher. Typically, more we like the 60 minute charts. But we are executing based on the price behavior of the 1 minute chart. All right, and because the subject matter for this webinar is entries, we're going to take you down to the 1-minute chart to show you the price behaviors that we're looking for. Okay, so we need to be very clear on that. We're not going to sit and stare at a 1-minute chart throughout the entire trading session. And we're going to talk a little bit about, scalping and establishing your trading model in a few moments, because it's important to understand things in context. But I want you to notice this. We just talked about this. You see how we have this price move from 36 to 47. It's only a 10-pip move, but it's a pretty inefficient move. Okay, and then price draws back to this breaking point right here, and right now it's showing just sort of some rising flows. And you see how when price is consolidating like this, liquidity is dropping off. So all we need is a little block of order coming in. It will run price up seeking liquidity. And then what it does is, once that is exhausted, even though this is just a couple pips, it gets exhausted, it comes back. So it feeds back into the larger area, of the most recent larger area of volume. Now, what we look for is, I'm looking for pretty well at a minimum a 20-pip inefficient move like this. Okay, so I've got my trading level based on my higher time frame, and that's fine. Okay, so let's say, for example, on the 60-minute, or let's take the 30-minute chart. I pick a level, and let's just say my level is going to be this area of order flow right around 85, 63, 85 or so, because we've got what's happened here is we've got some volatility resulting from the data, some core volatility, and then price runs out from there fairly inefficiently. So you're going to see when price comes up here, it draws back up this leg. We're highly, highly likely to see, based on my years of experience, we're highly, highly likely to see price responsiveness, unless, of course, there's a massive data event that comes out. You're not going to stand in front of data. So we look for a price response here. Now, what specifically we're looking for is a price run. This is a 5-minute chart, so we're probably going to see, if volatility just remains passive, we're probably going to see just a modest response in here, a shift in volatility here. Then if price runs up to around 80, we're looking for a trade around that area. Now, if price runs lower, we'll probably see price shift at the lows, and then if it runs inefficiently, we'll draw back up that leg. So there's two things that I'm looking for. Number one, I want to see a quite inefficient move into that area on the smaller time frame, and I want to see a pretty good area of sort of volume resistance here. This it's not great. I would put it in the sort of 70th percentile in terms of price responsiveness, because it's not that core. We have a little bit of a void right in here, but still pretty likely to manage a trade. Now, while I have this level picked out, what's going to determine whether or not I trade at that level is the anatomy of the price move and the order flow into that area. So if I see the pricing engine kick into place and I start to see a fairly inefficient move into that level, I'm going to trade into it. Okay, so now one may understand this to be a trade into the trend. The trend, to us, we are volatility traders on an intraday basis, so we're not trading into trends. We are trading into price moves, however, on a very, very tightly discretionary basis, based on countless experiences. But we're looking to trade into a price move. And let's just break it down into probabilities. So if we just look at price behaviors, I think we've got some examples here in the pound dollar. We go back on the pound dollar. I wanted to show you just recent behavior just from the last few sessions in pound dollar. So here's the kind of thing that we're looking for. You see how price consolidates and it runs out to the magnitude of 20 pips or more, and then price draws back up into this exposed area. That's what we're looking for. And you see on these price moves, it happens over and over and over and over again. See how price tightens up, it breaks out, it comes back. Okay? Price tightens up, it breaks out, it comes back. Now, on the breakout mover, as price is moving, we're looking for defined levels. So here, price tightens up, it breaks out, it moves beyond the last low. It's hot. When price breaks out, it's inefficient. Inefficient is the pricing engine is running. As it breaks through the lows, it becomes even more inefficient, and that's where we like to make the trade because it is highly, highly likely to rebalance and draw back up that inefficient leg. Okay, we see that price behavior pattern repeated, almost countless times throughout the day on all levels. So price runs out, draws back. Here, price runs out, draws back. All right, so it is a constant behavior. Price runs out, draws back. Here we see price run and draw back. Runs out, draws back. So it's happening all day long. So what we do to refine our trading is we are looking for the high probability areas where price is likely to stall. So we're looking for the level, in this case, of resistance or support where price will stall and draw back into an inefficient move. So down to the 1 minute chart. Now let's just break it down in terms of what it means for how we take on the entry and how we manage the position. So if we take an example, and we haven't had a lot of volatility here on the in the last couple hours, but so here we run from 25, okay, from 25 up, and it runs up into this level of it's resistance only on a 1 minute chart, so we don't place much weight on it. But and we're going to talk about exercises in a moment. But price, what I want to see if I enter is if price runs up, the pricing engine is moving, order flows, it's pushing price higher. So the more it pushes, the weaker it gets as price runs up into an area of order flow here. So think about this area of order flow in terms of a higher volume of transactions, not necessarily volume, but transactions. As price hits this level, we are looking for price to stall at this level. So we would trade it like in an example like this. There's two things that are important to this move. Number one, it's modestly inefficient here. So if we have an inefficiency at the breaking point, we're highly likely to respond. Number two, the more this runs, the weaker it gets. So you can see price rallies and stops, rallies, stops, rallies, stops. This is riddled with inefficiencies. Now we start getting a little bit more volume, but price runs into this level. So what we will do is once we start to see weakness or once we start to see the ticks changing, so for example, price will tick, and then all of a sudden we start to see ticks gap down a little bit and then pop up and gap down quickly, we're starting to see some weakness in the move. So we'll execute an order, and so this area is going to act as protection for us. So in this case, we might put a stop. Let's say, we've got this area of order flow. We've got point of release here. So let's say you put the stop up at around or above the round figure to start the trade. And I'm not going to get into the whole formula of average gain to loss ratio and all that. But what we're looking for is, so let's just say this is above 60, so we're looking for a level of resistance. But this level is going to come from a higher time frame. So once we start to see price response, watch what happens with the order flow here, okay? Watch what happens. So we see price, area of order flow here, price breaks down. We have a nice inefficient move into the level, and I'm just speaking conceptually here. So the trade, once the trade is made, we're partially protected by this area of order flow, but you probably want to put the stop above this high as well to start the trade. Now, watch what happens with price. So you see how we have an order flow here and here. Once this area of order flow breaks down, okay, you see how it breaks down here, then our stop comes down. straight away. Probably put it like above 50 because you might come back up and retest. So once this area of order flow breaks down, we're highly likely to draw back into this inefficient leg just to rebalance. Okay, so you see the order flow here and then here. Okay, and then price draws back into this leg, and then we're probably going to see some responsiveness down around here where the move started. See where the move started? So again, it's a 1 minute chart, so it's only a couple pips in here. Now we even have an inefficient area here, and you see how price is sensitive to even. You see right here how this is just a 1 minute chart. Here, exposed area, price comes back up, fills in the exposed area, order flow, and then it's a whole new ball game. But from the perspective of volatility and probabilities, is this. The bottom line is this, is that when price moves out inefficiently on the pound dollar, highly inefficiently, so it comes from base, moves out inefficiently, moves into a higher area of volume, this leg is highly vulnerable, okay, because all it takes is one entity. I've done some webinars in the past, and I think at FX Street, there's if you look at some of the other webinars, there might be a little bit more detail on this. But the way it works is you have a spread of investment banks, and all it takes is one investment bank to come in and start to shift price, then it draws up the third-party aggregators and the international feed. So it draws up, and the banks' algos go into self-protectionist mode, and they will run price up, and they will draw the liquidity and demand coming in through their institution. They draw it up and thin out price. They break down the orders, thin out price, and run it up. So then when that gets exhausted, price draws back in. So from a probability perspective, when we see an exposed area like that running into a high volume area, then we're highly likely to see price drop. So therefore, we manage the trade accordingly. And so we have probabilities coming from two perspectives. Number one, the probability of whatever our level is to hold, a weak move into that area, and the high probability that price will draw back into that leg. Now, I've been doing this for 14 years now, and I have virtually countless sample sizes of this. And this is not something you want to just go out and just throw money on the table and try it this afternoon. You need to go through a specifically designed protocol to internalize these price behaviors, okay? And everybody trades differently. So in any event, we're just trading the shifting in probabilities and our understanding of the intimacy of price behavior. So that's effectively how we would manage an intraday volatility trade. Now, we're not scalpers per se. We only pick the high probability levels where we're anticipating response. So we might pick a level, and price behavior movement into that level may be undesirable, so we may pass on the trade altogether. Now, when we're in really good connection and flow with the market, we might increase the frequency of trades. But think of this: if you're making 5 trades a month and you're not profitable, if you make 50 trades a month, you're going to be compoundingly not profitable because you're going to be 45 of your trades are going to be even lower probability than the initial 5. Okay, so I need to note that in order to adapt any trading protocol, any trading approach, one needs to go through a very, very structured design of internalizing, in this case, if I'm just talking about price action, of internalizing the price behaviors. So I have a very, very specific protocol that I will put someone through in order to help them to internalize price behaviors. And because it's got to be completely and fully internalized and understood at a very deep level. If you're out trading, just trying to copy what somebody else does, it's virtually impossible to copy what somebody else does at anything. And trading is probably one of the most difficult. So we don't want you to be in the mindset of, if I copy what they do or if I copy their system, I should be able to trade successfully. If they trade successfully, I should trade successfully. The point at which you'll first start to realize success in your trading is the point at which you place all of your trust and faith and belief in what it is that you have learned and what you do and your parameters and your capacity to think independently. You have to be an independent thinker. In order to be an independent thinker, you must have gone through the process of developing and refining your skill in order to do so. So it's not unlike what you currently do with your present occupation. You've become highly skilled at it. At one point, you were not skilled, and you evolved and emerged and grew into a position of acquiring and developing the skills to become highly effective and efficient at it. Trading is no different. Okay, so it needs to be respected and approached as such. Okay, so anyway, that's sidebar there. But back to this is basically what we look for in trades. So let's just have a look at what's going on now. So right now, price is pretty choppy, and what it's telling me is that on the day we've had the fundamentals come out, the market spends the majority of its time in consolidation, which is why we take this approach, is because market will run out and draw back into consolidation. Price spends the majority of its time drawing back into previously quoted prices rather than achieving new prices. So, which is why I'm not a price chaser. Okay. So, and I assure you this works. Now, a comment here, but we have to learn from successful traders. Yes. So what we do, FX Boyke, is the way I learned was I was drawn toward price behavior from my mentor, who's he's a private trader, and this is many years ago, and so to me, price action made sense because it directly connects you with the behavior of the market, and so when volatility and sentiment changes, we are the first ones to pick up on it. Literally, we pick up on sentiment changes on an intraday basis, and mathematical models will take days to adjust. But we can see it. We can see the changes in flows and behavior throughout the entire day, intra-week, and we can adapt quite quickly. So, yes, I think when you listen to traders, webinars, and whatnot, it gives you good insight in terms of how they think, how they approach the market. And, for example, I can walk through price behaviors, and so rather than you taking 5 years trying to first identify a price behavior, you can identify with the price behavior, then adapt it into your own psychology. Okay, so that's the idea. Is I show you a price behavior, you go out, you go through the protocol and approach it in such a way that, does this make sense to me? Can I see the repetition? Can I see the price behavior and relate it back to the order flows? Can I see the whole mechanism at work when I stare at this chart? Can I see the consistencies in patterns and behaviors and try to refine parameters to take entries and manage risk on it? So that's where an educator can help you to accelerate your learning process. But at the end of the day, you have to put in the work to really ultimately refine it so you become an independent thinker. And I remember the moment that my trading really took off was when I placed 100% confidence in what I understood about the market. Let's see if there's anything else. Let me look at some notes here. So as far as position management goes, that's pretty well what we do. Usually I'll pull up a 5-minute chart to manage the position. But the first objective is once that order flow shifts off the top in this case. Let's go back. Once the order flow, you see how you got the order flow here? Once it shifts and moves off the top, we're probably going to come down and fill in this this inefficient move into that higher area of volume. You're going to get retest spikes like this, so you got to be careful. But I open up the stop with some room for volatility, but immediately move that down to try to secure and tighten up the risk on that trade. And then we have resting profit positions in here as well, and so forth. But this is it's a very modest example, but I wanted to take something just from recent price behavior. Okay, so if we're at 44 now, and if we ran up to 80 from here, and we were fairly inefficient, to me that's a pretty good move. We also right now looking at this, I wouldn't be too keen on trading 60, but if we ran inefficiently to 60, that you can probably see price draw back. If we run towards the lows and we pop through the lows toward the big figure, to me that's a trade. So the exits, FX Boyke, the exits, what we do is you see these small areas of order flow. For example, as price runs lower, if we're highly inefficient lower and we make a trade, we're basically, you see these how order flow breaks down. Okay, this is a good example right here. This is all totally hypothetical. Let's just say, for example, you were to hypothetically, make a trade somewhere in here. You see how price ran down, picking up orders here and drew right back up. It's quirky price behavior. Anyway, if I was for any reason long here, you see this just level of order flow. So you've got a nice inefficient move. Price settles down. You've got order flow. Notice how it contracts, and runs. Now this exposed area, watch what happens. So price here is just consolidating. Let's say for whatever reason you were long here. Now we are placing our profit levels. The first goal in a trade is to secure your equity and try to secure some equity. Okay. Now watch what happens. So we have to take something out before here, because here's what can happen. So price comes up, it hits this area of order flow, then bang, it moves lower back into this inefficient light, and it does not break through. If I'm looking to secure equity up at higher levels, I run a very, very high risk of price just hitting this level and continuing lower. Just like it did like here. It did it here. So, for example, price drew down, came back up, stalled at this level, then the order flow continued lower. So when it does this, you see how it's highly inefficient, draws back up, fills in the inefficiency, then even this inefficiency comes back and fills. So if I don't take something out here, bang, you're done, and price washes out your trade right here. You need to take something out. You need to secure some equity. So whether you secure, all of it or just some of it, looking for price to draw back up even deeper, it all depends on, the framework of the trade. Okay. All right. So I don't know if, what do you think is a good performance for a trader in terms of average number of pips? That's a very, very gray area question, because trading approaches, if I give you one number or whatever, it just depends on trading approach, and so it's a very open question. Depends on where you're at in your development, what your model looks like. Are you just trading one flat out model, one type of trading pattern? It all depends. Trade frequency. Okay. I think, Jonas, you're correct. If you can get yourself to break even, that to me that is an outstanding foundation to work from. And if you go break even for like 3 months, 6 months, if you're just flat out broke even, it is a very, very good foundation, and it probably doesn't take much tweaking to get yourself to the next level, to be consistently profitable. Yes, I prefer, Jack, I prefer the 1 hour for entries. Jack, you're from Singapore? I've done a few presentations in Singapore. I don't know if you've been to any of them. Rahman, how are you? Okay, folks, admin is asking us to wrap up. There's another webinar on FX Street. If you wanted to check it out, I think there's one or two in there. It covers this in a bit of a more formulaic manner as well on chrislaurie.com. There's a lot of free videos and free education on chrislaurie.com. Okay. Thank you all very much for attending. Thank you, FX Street. We appreciate it.